Have you noticed the recent performance of Hershey's stock? It's been quite a roller coaster ride. The Hershey Company, an American multinational company and one of the largest chocolate manufacturers in the world, has had a tumultuous journey on the trading floors over the past year. It's a story that has left many investors and financial analysts scratching their heads. In the course of a year, Hershey's stock has seen a significant decrease, plummeting by roughly 29%. This is a sharp contrast to the S&P 500, which has seen an uptick of around 25% during the same period. The current trading price of Hershey's stock hovers around $183.54, teetering close to its 52-week low of $178.82. This is a far cry from its 52-week high of $276.88. This stark contrast in performance raises questions. What factors have contributed to Hershey's less-than-stellar performance on the stock market? Is this a temporary blip, or does it signal a deeper issue within the company? And the question that is probably on every investor's mind: is this a good time to buy Hershey's stock, or should they steer clear? Over the next few minutes, we'll delve into the nitty-gritty, exploring the company's dividend metrics, growth, financial health, market performance, and potential risks. We'll also provide a detailed valuation analysis to help you make an informed decision about whether Hershey's current stock price offers a good buying opportunity. Remember, the stock market is a complex beast filled with uncertainties, but with a little bit of knowledge and understanding, we can navigate through its ebbs and flows. So buckle up and get ready for an insightful journey through the world of Hershey's stock performance. So what's behind this drop? Let's delve into the details. First, it's worth noting Hershey's robust dividend yield. This sweet treat of a company maintains a solid 3% dividend yield at its current share price. That's a tasty return for investors looking for reliable income. But the dividends aren't just a one-time treat, they've been growing like a beanstalk over the past decade. Imagine this: 10 years ago, Hershey's dividend was just $1.81. Fast forward to the year 2023 and it's ballooned to $4.46. That's more than a double scoop of growth. But Hershey didn't stop there. The company recently announced a 15% dividend hike. That's right, the payout has jumped up to $5.48, serving up an even sweeter deal for investors. The growth of Hershey's dividends is like a well-tempered chocolate bar. It's smooth, consistent, and brings a smile to your face. But it's not just about the money in your pocket, it's a signal of the company's confidence in its future prospects. Hershey has been able to maintain this dividend growth by consistently generating profits and effectively managing its cash flows. This is a positive sign for any investor, as it shows that the company is not only profitable, but also capable of returning a portion of these profits to shareholders. But like a chocolate bar left out in the sun, there are some concerns that this sweet scenario might melt away. Can Hershey continue to increase its dividends at this rate? Will the company's free cash flow support these increases in the future? Sure, Hershey's dividends have grown significantly over the past decade, and the recent hike is a cherry on top. But it's worth remembering that past performance is not indicative of future results. Impressive dividend growth, isn't it? But can it sustain? That's the million-dollar question. And to answer it, we'll need to take a deeper dive into Hershey's financial health and market performance. So, stick around as we unwrap more insights in the next scenes. Hershey's dividend growth is indeed commendable, but how sustainable is it? Over the past decade, Hershey has consistently demonstrated robust dividend growth. The company's 10-year dividend compound annual growth rate, or CAGR, stands at an impressive 10.4%. This growth rate is a testament to Hershey's commitment to returning value to shareholders. In more recent years, Hershey has continued to outdo itself. The 5-year dividend CAGR has been even stronger, clocking in at 12.88%. This acceleration in dividend growth is an encouraging sign that Hershey's management is confident in the company's ability to generate increasing profits over time. Now, let's take a moment to appreciate these figures. A 10-year CAGR of 10.4% and a 5-year CAGR of 12.88% are no small feats. They indicate a company that is not only committed to its shareholders, but also capable of delivering on its promises. This is a characteristic that is highly sought after by income-focused investors who rely on dividends for a significant portion of their total returns. However, as with all good things, there are concerns that this robust dividend growth may not be sustainable in the long run. The primary concern hinges on the company's free cash flow. Free cash flow, as a reminder, is the cash that a company generates from its operations after accounting for capital expenditures. It's the lifeblood of any business and a critical factor in its ability to pay dividends. Hershey's free cash flow has been growing at a compound annual growth rate of 6.36% over the past decade. While this growth rate is positive, it's noticeably lower than the company's dividend growth rates. This discrepancy raises questions about the sustainability of Hershey's dividend growth if its free cash flow does not improve. If Hershey's free cash flow growth continues to lag behind its dividend growth, the company may find itself in a position where it's paying out more in dividends than it can afford. This could lead to a cut in the dividend, a move that is generally frowned upon by investors and could lead to a drop in the stock price. Despite these concerns, it's important to note that Hershey's management has shown a commitment to maintaining a healthy dividend. The recent announcement of a 15% dividend hike, leading to a current payout of $5.48, is a testament to this commitment. So, as we look at Hershey's dividend growth, we see a company that has consistently delivered robust growth to its shareholders. However, we also see a company that needs to improve its free cash flow to maintain this growth. So, while the dividend growth is impressive, its future hinges on cash flow improvements. Now, let's talk about Hershey's financial health. Hershey has been maintaining healthy payout ratios, a critical metric that helps determine the sustainability of a company's dividends. With a payout ratio of 47.75%, Hershey is returning less than half of its earnings as dividends to shareholders. This leaves a considerable portion of earnings for reinvestment into the business. Similarly, Hershey's free cash flow payout ratio stands at 57.28%. This ratio compares dividends to free cash flow, where free cash flow is the cash a company generates after accounting for capital expenditures. A lower ratio means a company can comfortably pay its dividends from its free cash flow. Hershey's ratio of less than 60% is a strong sign of dividend sustainability. But what about the growth of Hershey's free cash flow? Over the past decade, Hershey's free cash flow has been growing at a compound annual growth rate of 6.36%. This growth rate is commendable, as a growing free cash flow allows a company to reinvest in its business, pay off debt, and return money to shareholders through dividends or share buybacks. However, there's a catch. While a 6.36% growth rate is decent, it might not be sufficient to support future dividend growth without improvements. Remember, Hershey's dividends have been growing at a much faster pace, with a 10-year dividend compound annual growth rate of 10.4% and a 5-year rate of 12.88%. This discrepancy between the growth rates of dividends and free cash flow is a point of concern. It suggests that unless Hershey can accelerate its free cash flow growth, the company might struggle to sustain the impressive dividend growth we've seen over the past decade. The financial health seems stable for now, but future dividend growth may need more support. What about the market performance and risks for Hershey? Well, it's been a bit of a roller coaster ride this past year. The Hershey Company, known for its mouth-watering chocolates and confectionaries, has seen a significant decrease in its stock price. It's dropped by roughly 29% over the past year, which, when you compare it to the S&P 500's rise of about 25%, is quite the underperformance. Now Hershey's stock is hovering around $183.54, teetering close to its 52-week low of $178.82. This is a far cry from its 52-week high of $276.88. So, what's causing this downward slide? One of the main culprits is the rising cost of raw materials, particularly cocoa. In the past year, cocoa prices have surged by over 39%. This surge is due to a combination of global supply chain issues and increased speculation from investors. Let's break that down a bit. Global supply chain issues have been a thorn in the side of many industries, and the cocoa industry is no different. Disruptions caused by the pandemic, labor shortages, and transport difficulties have made it harder and more expensive to get cocoa from the farms to the factories. This, in turn, has sent the cost of cocoa, one of Hershey's key ingredients, soaring. Then there's the investor speculation. As the saying goes, buy on the rumor, sell on the news. As rumors of these supply chain issues started circulating, investors began buying up cocoa, hoping to profit from the anticipated price increase. And as more investors jumped on the bandwagon, the price of cocoa started to rise, which only fueled more speculation and higher prices. Now, you might be thinking, well, Hershey is a big company, can't they just absorb these costs? The answer is not so simple. Yes, Hershey is a large corporation with deep pockets, but it also has a responsibility to its shareholders to maintain profitability. So, while it can absorb some of these costs, it can't absorb them all without impacting its bottom line. And that's not the only risk Hershey is facing. There's also the risk of consumer backlash. As the cost of cocoa rises, Hershey may have to raise its prices to maintain its profit margins. But if prices go up too much, consumers may start looking for cheaper alternatives, which could hurt Hershey's sales and market share. So the market performance has been shaky, and the risks are real. But as with any investment, it's important to weigh these risks against the potential rewards. After all, every cloud has a silver lining, and for Hershey, that could be the sweet taste of recovery. Now, is Hershey's current stock price a good buying opportunity? This is the question we've been leading up to. Let's dive into a detailed valuation analysis to find out. Remember, you can follow along with our custom spreadsheet from tickerdat.com. Firstly, let's consider the price to earnings, or PE ratio. The PE ratio is a simple way to assess whether a stock is over or undervalued. It compares a company's current share price to its per-share earnings. Hershey's PE ratio has been hovering around 22, which is slightly higher than the average of the S&P 500. This suggests that investors are willing to pay a higher price for Hershey's earnings. Next, we'll look at the price-to-book, or PB ratio. This compares a company's market value to its book value. A lower PB ratio could mean the stock is undervalued. Hershey's PB ratio is at a modest 3, which is in line with the industry average. Let's not forget the debt-to-equity ratio. This measures how much debt a company is using to finance its assets relative to the value of shareholders' equity. Hershey's debt-to-equity ratio stands at around 2, which is higher than many of its peers. While this isn't necessarily a red flag, it's something to keep an eye on. Now, onto the dividend discount model, or DDM. This model values a stock by assuming that its worth is equal to the discounted sum of all of its future dividend payments. Given Hershey's strong dividend history and the recent announcement of a 15% dividend hike, the DDM suggests that Hershey's stock might be undervalued at its current price. Lastly, let's consider the free cash flow yield. This measures the cash a company generates that could be available to investors. A higher yield can indicate a good investment opportunity. Hershey's free cash flow yield has been steady at around 5%, which is slightly above the industry average. So, what does all this mean? Well, the metrics we've considered suggest a mixed picture. The PE ratio and debt-to-equity ratio suggest that Hershey's stock might be slightly overvalued and that the company has higher debt levels than some of its peers. However, the PB ratio, DDM, and free cash flow yield suggest that Hershey's stock could be a good buying opportunity. Remember, these are just tools to help you make an informed decision. They should not be the sole basis of any investment decision. It's also important to consider other factors such as Hershey's performance relative to its competitors, its future growth prospects, and broader market conditions. So, that's a comprehensive look at Hershey's performance and valuation. It's up to you to make the sweet decision. And with that, we've come to the end of our deep dive into the financial health, performance, and valuation of Hershey's. Now that we've armed you with this information, it's up to you to make the sweet decision. Remember, investing is not about chasing after the most popular stock, but about understanding the business and its potential for growth. Hershey's may or may not be the right investment for you, and that's okay. The important thing is, your decision is informed and aligns with your financial goals. If you found this video helpful, we encourage you to leave a comment below, share your thoughts or any questions you might have. Your feedback helps us create more valuable content for you. And if you haven't done so already, don't forget to hit the subscribe button. We continuously bring you sweet insights into the world of finance, investing, and much more. Remember, the journey to financial freedom is a marathon, not a sprint. So, keep learning, keep investing, and keep growing. Thank you for watching, and until next time, happy investing.